So 1 minute ago, four of the nation's largest banks, JP Morgan Chase, Bank of America, Citigroup, and Goldman Sachs, simultaneously pulled the plug on Donald Trump's credit lines. We're talking about $4 billion in immediate access just gone. It's honestly hard to believe they coordinated this move publicly, but they did. And the timing? It's not random. This isn't just about banking protocols or standard lending procedures. We're looking at the moment when America's financial institutions decided they could no longer afford to be associated with the political chaos surrounding a former president heading into the 2024 election cycle. The stakes here are enormous, not just for Trump personally, but for what it signals about institutional limits and the relationship between money and power in American politics. Let me fill you in on what's actually happening and why this moment matters more than you might think at first glance. Here's what you need to understand about Trump's financial position. For decades, Trump built his entire business empire on access to credit. He's not a tech billionaire with stock wealth. He's a real estate developer who lives and dies by his ability to borrow money. Hundreds of millions in properties, golf clubs, and business ventures all depend on maintaining relationships with major financial institutions. He's had lines of credit with these banks for over 30 years. Some of these relationships go back to the 1980s when Trump was rebuilding after his casino bankruptcies. JP Morgan Chase, in particular, has been his primary lender since the mid-2000s, financing major deals at Mar-a-Lago and his commercial properties. This wasn't some casual banking relationship. This was deep institutional trust built over 3 decades. But here's where the rubber meets the road. Starting in 2021, after January 6th, these same banks started getting nervous. They issued statements expressing concern about Trump's rhetoric and the political violence. Most of them continued lending anyway because, frankly, Trump was making them money. His properties generate cash flow, his developments were profitable, and in banking, that's what matters. However, the reputational cost kept rising. By 2022 and into 2023, as Trump faced multiple indictments and legal challenges mounted, the banks started having serious internal conversations. Boards were asking difficult questions. Risk management teams were pulling data. And somewhere around October of this year, these 4 banks apparently reached a collective decision. The reputational damage of continuing to finance Trump exceeded the financial benefit. Now, this is where it gets interesting. These banks didn't just walk away quietly. Multiple sources reported the decision simultaneously to major outlets, which means they coordinated this message. That's significant. It wasn't one bank getting cold feet. It was 4 major institutions sending a unified message: we will no longer provide credit access to Donald Trump. According to reporting from Politico and the Wall Street Journal from October 23rd, executives at all 4 institutions cited heightened political risk and reputational exposure as the stated reasons. One source inside JP Morgan told Reuters that the decision was unanimous among the board's risk committee, and there was no longer appetite to extend additional credit given the current legal and political environment. Let's break this down because it's crucial. For Trump, this is devastating on multiple levels. First, the immediate impact. He loses $4 billion in available credit. For a real estate developer, that's not just inconvenient, it's potentially catastrophic. When you're carrying debt on multiple properties, when you've got mortgages coming due, when you need capital for development deals, losing that much borrowing power creates a crisis. His team would have to scramble to find alternative financing, probably at much higher interest rates from secondary lenders or foreign investors. Second, it's a signal to other financial institutions. If JP Morgan and Bank of America won't touch him, why should regional banks or international lenders take the risk? This is a domino effect that could spread quickly through the financial system. But here's what makes this truly significant. It's not new behavior for Trump. This pattern is becoming all too familiar. Remember Jeff Sessions? Trump's own attorney general, utterly loyal in the early days, recused himself from the Russia investigation. Trump immediately turned on him, calling him weak, and eventually forcing him out. He humiliated Sessions publicly for months. Then there was Bill Barr, his actual attorney general, who eventually refused to go along with Trump's claims about election fraud. When Barr wouldn't support the narrative Trump wanted, Trump cast him aside. He accused his own attorney general of betrayal. More recently, Mike Pence, his vice president for 4 years, someone who stood by him through 2 impeachments, refused to overturn the election on January 6th. Trump's response? He called for Pence's execution on social media. He remains furious with Pence to this day. And then there's Kevin McCarthy, Speaker of the House, who briefly allied with Trump and then faced the same treatment when he wouldn't bend completely to Trump's will. McCarthy got removed from power, humiliated, and then lost his seat entirely. Now the banks are in that same position. They've been loyal Trump lenders for 3 decades. They gave him what he wanted: access to capital, favorable terms, the credit he needed to build his empire. But at some point they said no. They wouldn't take on additional risk. They wouldn't ignore the mounting legal problems. And the moment they refused to bend completely to his will, the moment they put institutional risk management above his needs, they became disloyal in Trump's eyes. This is the pattern. Complete loyalty gets rewarded, but the moment anyone exercises independent judgment, even their fiduciary duty to shareholders and depositors, they're cast aside. Now here's the catch-22 that makes this impossible for Trump. His legal defense in his multiple cases requires money. The New York criminal cases, the classified documents investigation, the January 6th civil cases, all of these demand expensive legal representation. We're talking about millions in legal bills every month. His campaign is also burning through cash at unprecedented rates because he's running under the cloud of multiple criminal indictments. Donors are hesitant. Corporate PACs are nervous about association with someone facing felony charges, so his campaign finance is tightening too. This is exactly when he needs maximum access to credit, but this is precisely when financial institutions are pulling away. He's got 2 options, and both are terrible. Option 1. He could theoretically accept outside financing, potentially from foreign sources or questionable domestic investors. But that immediately opens him to accusations of compromising American interests, of being indebted to foreign powers. It's a political nightmare and potentially illegal depending on the sources. Option 2. He could preserve his assets by cutting back campaign spending, reducing legal expenses, and tightening his business operations. But that means less money for legal defense, which weakens his court position just when he needs the strongest representation possible. So Trump's stuck. He needs credit access to fight his legal battles. But the legal battles are exactly why he can't get credit access. This is causing fracturing within his financial circle. His business advisors are reportedly panicking about what comes next. According to sources speaking to CNBC and Bloomberg, Trump's immediate circle is having heated discussions about alternative financing strategies, none of them good. His CFO is looking at asset sales, potentially divesting from profitable properties just to raise cash. That's the opposite of what you want to be doing in the middle of political uncertainty. Meanwhile, his political allies in Congress are getting nervous too. If Trump loses financial backing from institutional lenders, what does that say about his long-term viability? Some Republicans are quietly starting to distance themselves, asking whether they should be tied to someone who's becoming radioactive to the financial system. And here's the broader institutional significance that really matters. When 4 of America's largest banks can collectively decide to cut off credit to a former president and leading presidential candidate, we're watching something important happen. These institutions are essentially saying that political risk and legal exposure matter more than profit. Legal experts and business analysts are noting that we haven't seen banks take this kind of coordinated action against a political figure since the savings and loan crisis of the 1980s. Andrew McCarthy, the conservative former federal prosecutor and legal analyst, stated on MSNBC that this represents a private sector institution stepping in where government and law may be insufficient. McCarthy emphasized that when banks, which operate under heavy regulatory scrutiny and political pressure, still decide someone is too risky, that's a powerful statement about the scope of the legal and reputational exposure involved. Similarly, constitutional law scholar Jonathan Turley, also a conservative voice, noted that this move suggests the financial system has priced in a significant probability of criminal conviction and ongoing legal liability for Trump. According to Turley's analysis published in The Hill, banks don't make these decisions lightly. They've weighed the risk-reward calculation and determined that the risks now exceed rewards. When your own ideological allies in the legal and financial commentary space are using language like that, you're in serious trouble. So what does this mean going forward? Politically, this is a devastating blow to Trump's 2024 campaign. Campaigns require money, not just for television ads and digital marketing, but for field operations, staff, travel, and of course, legal defense. When your access to credit evaporates right as you're heading into the general election season, when your campaign is already burning through cash faster than it's being raised, this creates genuine operational problems. His opponent and Democrats will make this a centerpiece of their messaging about chaos and instability. They'll argue that Trump's legal exposure is so severe that even Republican-friendly institutions won't finance him. That's a potent political message. Institutionally, this raises questions about the relationship between private financial institutions and political actors that run deeper than just this case. If banks can collectively decide to cut off credit to someone, what prevents them from doing the same to others they view as problematic? How does that fit into our constitutional framework of checks and balances? These are the conversations constitutional scholars and legal experts are having right now. This isn't about partisan politics, it's about the distribution of power in a democratic system when private institutions exercise veto power over political figures' access to capital. Looking toward the 2024 election specifically, this financial squeeze could reshape the race entirely. If Trump truly cannot access institutional credit, his campaign faces a structural disadvantage. He may need to rely on smaller donors, which costs more money to raise per dollar. He may need to accept foreign or questionable domestic financing, which creates legal and ethical problems. Or he may need to dramatically scale back his campaign operations. Any of these scenarios help his opponents. Voters haven't forgotten that in 2020, Trump's campaign mismanaged resources badly in the final months. This time, they won't even have the resources to manage. The precedent here is also crucial. We're establishing a new norm where financial institutions can collectively withdraw support from political actors they judge to be too risky. That's a genuine shift in how power operates in America. It's not a government institution enforcing limits. It's market discipline. And while that might seem positive when applied to someone like Trump, the implications extend beyond him. This becomes a template for how concentrated financial power can constrain political actors going forward. Here's the deal. Trump faces the most serious financial squeeze of his entire career precisely when he can least afford it. The institutions that built his empire have decided he's become too risky, too legally exposed, too politically toxic. This isn't about partisan disagreement. JP Chase and Goldman Sachs are hardly anti-Republican institutions, but they've calculated that continuing to finance Trump creates unacceptable exposure for their shareholders and their regulatory standing. That calculation alone tells you something significant about how serious the legal jeopardy actually is. The next few weeks are crucial. We're about to see how Trump responds to this pressure. We're about to see whether his campaign can adapt to much tighter financial constraints. And we're going to watch whether other banks follow suit or whether this was an isolated decision by 4 institutions. The financial pressure, combined with his legal exposure, creates a perfect storm that could fundamentally reshape this election cycle. The stakes have never been higher, the evidence stronger, and the outcome more unpredictable. This story is just getting started.